We already have a firm grasp on the idea of risk-reward ratios and overall expectancy of a strategy, which comes from the average of ratios produced over a certain period. The expectancy is a good metric to measure the risk health of a trading strategy. In this lecture, we are going to look at a more specific attribute of risk-reward ratios, which is the margin of error that they offer. For each level of risk-reward ratio, the trader obtains a percentage of margin of error in which he can rely on. For example, if you trade consistently using a ratio of 1 to 3, you can be wrong 75% of the time in your trade decisions and break even. That happens because for every profitable trade you make, you can make 3 losing trades and break even. Let's see the mathematics of that in a quick example. Imagine, for simplicity's sake, that in every trade you make, you risk 1% of your capital and you expect to win 3% in return. We clearly have a risk-reward ratio of 1 to 3. Imagine also that you have made 2 profitable trades in a row, producing a 6% return on your capital. Since you lose only 1% of your capital if you are wrong in your decisions, you can be wrong for the next 6 trades. Imagine that you end up being wrong in the next 6 trades and you end up breaking even. Let's calculate your win ratio. You made a total of 8 trades and you lost 6 of them. In other words, you were wrong in 75% of your trading decisions, and your win rate was only 25%. By using a good ratio like 1 to 3, you were able to protect your initial capital even while being wrong 75% of the time, which is a lot. Let's look at the different margins of error for the different ratios so we can take this whole analysis to the next level. Here we can see something interesting. As we increase the ratios, the margin of error obviously increases, but the size of the increment decreases. We can observe that by calculating the increment in the margin of error obtained with each ratio. For example, a 1-to-1 risk-reward ratio gives us 50% of margin of error while a 1 to 1.5 risk-reward ratio gives us 60% of margin of error. The increment between these two levels is 60% minus 50%, which results in a 10% increment in the margin of error when we jump from the first level to the other. If we plot the increment column in a chart, we will notice that a decreasing logarithmic curve appears. In practical terms, this means that in the beginning of the table, the increment we get with each risk-reward level is high. After a certain point, the increment in the margin of error starts to get smaller and smaller while the risk-reward levels increase arithmetically. If we want to have some sort of statistical edge in the markets, we must choose a range of risk-reward ratios that is realistic at the same time it provides a good margin of error. In the beginning of the curve, the margins of error are not so good. More towards the end of the curve, the margins of error are good, but the ratios are unrealistic in a trade-to-trade basis. That does not mean that making a trade with 1 to 10 ratio is not good. It's just not realistic to expect that in every trade. Most of your trades should live within the 1 to 3 to 1 to 5 ratio, but occasionally you will find exceptionally good trades that will stand out, and that's perfectly fine, of course. The ability to trade having a good and realistic margin of error is the most important aspect of risk management because that's precisely what guarantees a certain level of emotional stability and peace of mind for the trader. That's because the trader will not feel the pressure of being right all the time, and he will still be able to make money. This risk configuration also avoids the bad psychological cascading effects that can happen when traders attempt to be correct all the time, as we will see in future lectures. The essential point of this lecture is to show you the optimal range of risk-reward ratios and how we conclude that this is the optimal range. In the next lecture we are going to explore the idea of risk contraction and expansion.